Hi, very glad to meet you this day. I am Professor Ramakrishna and this is my YouTube channel. It is Archiversity. Through this YouTube channel, I create hundreds of videos and share my knowledge with audience like you across the world. In today's lecture, I am going to explain you the concept of a capital market line. So capital market line is used in an efficient frontier or a portfolio which helps us to calculate the expected return on a portfolio. That is an expected return of an optimal portfolio. So this is similar to your security market line. However, the difference is that in case of a security market line, we consider the market risk, whereas in a capital market line, we consider the standard deviation of a portfolio in calculation. Now I'll take you to my OneNote where I explain you the formula of a capital market line, and I also solve you an example and show you how to determine expected return of an optimal portfolio using a capital market line. Here is the capital market line, and the formula that we use to capital market line, that is the expected return under a capital market line, is your risk-free rate and standard deviation of a portfolio, then return on a market, then risk-free rate and standard deviation of a market. Right here, instead of calculating the market risk, we are considering the unsystematic risk or a portfolio individual risk. So similarly, we are also calculating the portfolio individual risk as well as a market individual risk and comparing this with the risk-free rate to calculate our expected return. Now here is an example. The expected return of a portfolio market standard deviation is 20%. That is portfolio. If the market standard deviation, you need to calculate the expected return of a portfolio. The market standard deviation is 23%. That is standard deviation of market. This equals to 23. Then your risk-free rate, this is a 4%. Then the return on market is 12%, and the standard deviation of a portfolio, is 5%. So that means to calculate our expected return of a portfolio using our capital asset pricing model, first what is that we need to have is a risk-free rate. Our risk-free rate is 5%. Sorry, risk-free rate is a 4%. You can take a 4% or convert it into decimal, 0.04. This plus standard deviation of a portfolio, this is 5%. So 0.05. This times return on a market. So your return on market is 12%, 0.12 minus risk-free rate, that is 0.04. Then this divided by your standard deviation of market, that is 0.23. So that means 0.04 plus, so 0.12 minus 0.04 is 0.08. So you will have a value of a 0.05 times 0.08, then 0.004 upon 0.23. So 0.174. So this is 0.0174. Then your expected return is 0.04 plus 0.0174. So 0.0574. So your expected return on a portfolio under capital asset pricing model is 0.0574, or we can say that this is 5.74%. So the expected return under a capital asset pricing model of this particular portfolio, when you are considering the unsystematic risk of both the portfolio as well as the market, your return is 5.74%. So this is how you need to calculate the expected return under capital market line. Thank you for your time and watching this lecture on a capital market line. I request you to visit Archiversity website as well as Archiversity YouTube channel, where you find hundreds of video lectures on finance, accounting, statistics, then pivot tables, Excel, SPSS, etc. So you can download the playlists and watch those playlists whenever and wherever you are. Thank you once again. Have a great time.